Good morning. Warm welcome to Munich. Thank you for your attention. I'm really happy to see a lot of shareholders and friends in the room, and those we would like to be friends. In the room we have some others still left, but I think we're trying to do our best today to make the last hesitant investors and others to make a real big fans of Allianz. I have a strong crew on stage today, so this is not a one-man or one-person show. Allianz is an institution that delivers. It's far less dependent, that's the good news, on the CEO than people think. And we will try to showcase that today. Now, before we dive into the future, just a little recap of where we are coming from when we launched the renewal agenda 3 years ago. Because people have gotten used to a lot of good news and no surprises from Allianz. But in itself, and given the environment, that is no and was no sure thing. So what I'm going to talk about is 4 things. First, take a little stock of the last 3 years, what has happened. Talk about what we're going to do in the next phase of our renewal agenda. And the headline is called Simplicity Wins. We're trying to decomplexize what we do and harness something that you have never seen in economics in our industry, that is called scale. Factually, we have diseconomies of scale in our industry, and we'll talk about how do we turn something from what we can call a conglomerate discount into a premium. Then a little bit on capital management from my side. Julie will talk a lot more about capital management and how we are going to deliver. And then I'll briefly touch upon the targets. And not just the numbers, what is the philosophy behind the way we set targets? And we will remain what you always known, conservative German at the heart, with the global power to deliver beyond what people think is possible. Now, you know that we are a global financial leader, but just as a little bit of a backdrop, we're expecting more than 11 billion in operating profit. By the way, people tend to forget that we're earning more than 3 billion in the United States. When people say, you know, what is your global footprint? We're earning more than 3 billion in the United States and growing. The value of new business from Asia, which was very low a few years back, is growing constantly. And we haven't compromised on capital strength. I think there's very few institutions or industry that have the balance sheet that we do have. And again, on the asset management side, I think is still underappreciated. We're managing more than 1.5 trillion in assets under management for third parties. That is not including the money that is managed for us. And we have the vast majority with our asset managers because we believe they are the best, not just because they're with us. Now, going a little forward, I hope that happens. When we said to set our targets, and I would like to particularly go on the earnings per share growth, the 10-year average that Allianz had achieved between 2005 and 2015 was 2.6%. Through the financial crisis, of course, but that was the number. When the current management team took over as a team, the analyst estimate of what we would do over the next few years was 2.4%. That was the consensus. Now, we said we need to rebase the expectations of our investors to how Allianz can grow its earnings. And we targeted 5%. Now, as of 9 months, we are looking at 7.1% compounded EPS growth over the last 3 years. And we'll talk about what we're going to do going forward. So this is 1.4 times what we gave ourselves at the target, and we really believed it's a stretch target, and it's 3 times of what the analyst community considered to be possible in 2005. Now, you may immediately say, if you're a cynic, yeah, when you do share buyback, that is easy to do. Well, in order to do share buybacks, you have to do a few things. And one of them is to have the money to actually spend it. Now, you can take the money and borrow it by leveraging your balance sheet, but you can also do something else. You can try to improve operating performance, and you can do it in a sustainable way. So this page, H5, is super important because we had given ourselves operating profit improvement targets across the entire universe of Allianz. Not just thinking through how we can help our colleagues in Newport Beach to refood themselves. Remember, we had a few 100 billion in outflows. The tide turned only in the second quarter of 2016. 2017 was the most successful year in the history of the firm, 145 billion net inflows. And in this year, which probably is one of the most difficult in the history of bond management, we're having positive flows. Very few do have that. And the same Allianz Global Investors, we're seeing, be on a not so successful business model, hodgepodge of leftovers, has proven to be extremely strong and are growing, while active asset managers, particularly those owned by large other firms, have been pushed to the wayside. Now, the key objective beyond turning around PIMCO and refooting the asset management segment was structurally rebuilding the life insurance business. And we wanted to have a new product set that reduce the capital consumption massively. Remember, still 65% of our risk capital, because of the reserve buildup, is in the life insurance segment. And we had to transform it. Now we have overperformed our target. 82% is in the new lines. On average, 60 to 70% less capital consumptive than just a few years ago. And our new business margin is north of 3.4%. And that given that a significant part of our portfolio is still in Europe with very low interest rates. And we tried to do the almost impossible, move all of our life businesses to earn a return on equity north of 10%, so making sure that with the volatility, we would never fall below the cost of capital. 93% is what we've been done. We have 2 or 3 small ones left. And let me tell you, we're working on making those either improve or find a different destiny. Instrumental, of course, was the sale of our Korean business at the end of 2016, what people still tend to forget. At the peak, the negative value was north of 1.5 billion. The other thing I'd like to mention is, why are we doing so well for consumers and our shareholders? Because we changed dependencies on traded equities and other instruments that we consider to be overvalued by moving consequently over many years into being a leader in alternative assets. We gave ourselves a target to have 110 billion in the portfolio in the alternative asset space. Obviously, a significant part in real estate. As of today, we are closing in on 130 billion, outperforming our own expectations. And that's very good for our shareholders because it detaches us from the volatility that you've seen in the equity markets and consistently delivering on something and building the competitive advantage that we have. That is excess liquidity that is not under stress. So that is what I wanted to talk about. We've made a lot of progress on digital and transformation, but Ivan de la Sota will talk a lot more about that. So let me just move onwards. The other thing that is very important is now we're starting to harness the benefits of working on the profitability side, because if you improve the margins consistently and if you work on managing productivity up, you start to see growth coming in. And it's very, very important to notice that this is not a low growth business anymore. Whether you see that in property casualty, in the life new business space, in third-party asset under management, or the total internal growth. And I think people do not have that in their mind as they think about Allianz. And these things are actually going in tandem. Only if you exceed in customer loyalty, you have the proper productivity, is growth coming. They are depending on each other, and they are not independent of each other. If you're trying to grow without having the prerequisite, you will wreak havoc eventually on margins. So it's very important that you see, and I'm very proud to see after a long time and spending on IT, that we see productivity growth coming through at the same time that customer loyalty is really picking up. Let's move forward. Now that you know, the shareholder returns relative to the index have been very strong. Thank you very much for your support, and we do not intend to change that picture. Now, let me summarize, therefore, the last 3 years and how do we move. The first one, PIMCO is back to top performance. GI is substantially strengthened. In life and health, we've restructured the business model to make sure we have the power to grow. And in P&C, we are closing in on the 94 combined ratio and the growth in the business, while others are losing top line. So therefore, what is next? What is next? What do we do? And the messages are, we have to do 3 things to drive the renewal agenda for the next chapter. We need to aim to outperform across the portfolio, not just in the vast majority. There's no room for leakage. We really need to transform the core of the business, not just optimize it. It's particularly important for the property casualty business. After many years of laying the foundations of, for example, retooling our IT infrastructure massively, and we need to rebalance our capital allocation internally even more towards the business where the growth and value creation is. Move away from the focus on top line across the portfolio on those where the value is, even if that's very difficult. So on top of that, I'd like to move forward. Now, why is this so important? We believe we're entering an era that is a lot less benign than the last 3 years have been, particularly in terms of the stock market. So we spend a lot of time analyzing our environment that was basically driven by significant economic growth globally, fairly stable political environments in booming capital markets, and having low interest rates. Yes, we knew, but we had enough time to deal with that, and we also had good time to deal with regulation. The next few years, ladies and gentlemen, are going to be very different. You saw that over the last few months. So we asked ourselves, how much do we want to be dependent on an environment that supports us? And the answer is absolutely nothing. We want to do what we have under our control, and we can say it, and we don't mean it in an arrogant way. We don't need help from anybody to get this done. Now, let's talk about it, how we think about it conceptually. So what we've done the last 3 years is to lay the foundations, to do the groundwork with our renewal agenda 1. Remember the turnarounds we had to do in asset management, the transformation in the life business, and bringing technical excellence to property casualty. So delivering on the outperformance agenda, the transformation, the rebalance requires 3 things in terms of focus. Number 1, bringing productivity to the core of our DNA. That is very important. Creating scalability to what we call the Allianz customer model, and we're starting in property casualty on the retail side and SME. And again, being more strict in capital allocation and giving targets to our businesses on where the capital needs to go, including building new businesses like our European direct platform that are acting in a legacy-free way environment. The tools are going to be the same. We do not want to, every 3 years, have a new way to run the company. We need stability. You know, some of our top investors this morning just said, we are investing in you for no surprises. We need stability in the way we do things, but we need to tweak a little bit the ambition. So I don't want to go through the details, but just give you a couple of examples. A lot of that is about culture. For the last 11 years I've been here, I was CFO. We have basically spent a lot of time with our businesses to negotiate plans and then making sure ambitious plans that they're being delivered upon. It was very much checked against the competition, but to be honest, it was all about how do I make my plan or out-deliver. It was less about how do I beat the best in the market. And that is what has to come now. The aspiration for all Allianz businesses has to be to beat the best in every market. And it's very tough to do, and we may not always be able to do that, but that is the aspiration. The other one is the constant feedback you get. Well, if you do a business transformation, your people will be unhappy because you're letting employees go and so on. It's just not true. Our most successful change leaders do reposition the business for the future and mobilize the people, even if that includes job losses at times, which are not the objectives. The second thing, and that is very important, is we need to move out of the boom and bust cycles that we had in our industry. When there are soft cycles, the markets go down. There's cost-cutting programs where you take money out of marketing, advertising, you stop investing in IT. This is not what we mean. What we mean is to move to a different level of operational excellence, starting with a very simple concept. The simpler we design our products and processes, the better it is for our consumers, and the better it is for our people, and I will talk a little bit about that in a second. Therefore, we will continue our drive to outperform the market as it stands today. We have about an NPS outperformance of 71%. I think it's more going to be like 72 by the end of the year. We need to move north of 75. And by the way, more on a personal note, today about 40% of our businesses are loyalty leaders, i.e. in customer satisfaction are the best of their markets. We need to move far beyond that to 50, because only if we excite our clients we will be great. Now, that every business is trying to do that today, so it's not about the ambition, it's about how do we deliver. But if you think about that, 2014 at the end, only 47% of our businesses, it's quite embarrassing actually, were better than market average. Just in 3 years, we moved this number north of 71. And that was a massive contribution by our business leaders. And we're going to continuously push on that. It requires more intuitive products. Well, the word intuitive and insurance rarely make it into the same sentence, right? So that is really what we have to do. We have to make sure, very parochial things, that processes are trouble-free for our people and our clients. And we are going to implement the most advanced technology to measure customer satisfaction in real-time frontline steering, called what we call voice of the customer. So no more telephone calls out asking people what they think. Having instant replies is what we're going to do. The same is very important on employee mobilization, and we need to get better at that. And I say it openly. We have to make sure that we are more purpose-driven in our culture, less expert-driven, and really train our people to not just be leading their people into technical excellence or towards technical excellence, but to be helping the business to transform. A key prerequisite is, by the way, and I'm going to talk about it a little more, and Ivan will do even more so, is to get rid of what we call legacy. We are excellent in inventing new things. We're very good at reconfiguring the platform and bringing new products. What we're not so good at is making sure that the so-called backbook is disappearing as quickly as it can. And we've now laid the foundation over the last few years by harmonizing our global IT to move, and we think we're unique in our industry, to discard the legacy. That will require energy, will require significant investments against increasing productivity. And our people will have to deliver that in a way that is legacy-free. Now, how do we define outperformance? There are many ways per market how you can do that. As an investor view, you would use some of these matrices, particularly for life and P&C. And you can see that in life insurance, and I think many investors do not have that on their radar. We're closing in really on best practice in terms of margin. You know, Allianz is coming from a very different point and starting point. And we're now ready for growth and innovation. Now, return on equity is not really the best number to assess an asset management business. Run rate revenue growth will be the number, in our opinion, for the future. Sustainable earnings growth will be very, very important, not AUM. I think the AUM focus is totally wrong, because a lot of low-margin business is flowing into balance sheets. And we are ready there because we are leading in profitability already, and we have proven in this environment to grow revenues like few others. And that leaves us with the focus on our core business, property casualty, the foundation of Allianz's success over many years. We're getting very close to the 94 aspiration base, but there's much more potential. There's much more potential. There's further upside, particularly through productivity. You've seen it this year coming through, growing particularly the retail space and doing massively better on analytical excellence. So let me repeat, we do not need the market to help us. We do not need a transformational M&A to fix a problem that we don't have. We're going to do it when it makes sense, but first we make sure we are the best at what we do across the portfolio. Now, there's a couple of examples of how you can use technology, and I thought about, how much time I spend on it. Since Ivan and the colleagues are going to give you the look into the machine room, just take as a note that we are not looking at, for example, artificial intelligence as a mumbo-jumbo thing that is somewhere in the back, geeks that we hire from Google and do something outrageous that we don't understand. This is about making everything that we do better every day. It's focusing on customer complaints. What is the average claim file duration in the business? How to bring the Net Promoter Score up? And how do we bring fraud protection up? These are real examples. This is an example out of Turkey, thinking through how we drive it through the business. So you get these examples every day. What you don't get is the impact it has on the business if you execute properly. This is the last conceptual slide I'm going to use, but let me just summarize what is it that we're trying to achieve. We call this simplicity wins, and we mean it. And we are a fairly complex organization, and it will not going to be super simple tomorrow. So this is a journey that we are on. But it starts with something that we hadn't really focused on enough. making sure we have massively fewer and more intuitive products that our consumers really like. And if we have to differentiate, we want to differentiate in modules so that additional variation doesn't cost us in the machine room. And we want to make sure we have no negative surprises. The key driver, by the way, for customer satisfaction is not the average NPS that we have, is getting rid of detractors. We have to get good in the machine room like any good manufacturing company is today. Digital is not about replacing humans. Everybody says this is about, the human-free enterprise. It's just not true. What we are going to take out is all the complexity that our people internally and externally don't want to have in the first place. That is trouble-free processes without legacy. Let me tell you, the last year we had a lot of IT challenges internally as we moved to a global data center structure. So doing that sounds easy. In practice, getting to global scale and having stable operations is not an easy thing to do. And then enhanced data analytics come on top. Now, the third one is very important for you as investors to think through. Our business for 200 years has not been scalable. In fact, most of us get a conglomerate discount because you say, how can you manage something better than the capital markets? So we need to prove that to you. And we've started already 14 years ago with a sustainability program on technical excellence. This is what we're really good at, taking rating and pricing technology across markets, product design in life, and globalizing it. So we're very good at it. What we've not been able to do is to bring it into the machine room. So harmonize products and processes in a way that we can replicate them across countries. And Ivan is going to talk about how we do that. And it was not born in my brain of some conceptual advisor. It was born by our CEOs. And 3 of them are on stage today that have gone through the journey the last few years to say, are our products locally really so much different than our middle managers are telling us? And they will tell you the story of how harmonized our platforms can be. And again, now we have the IT stack to actually do it. Last but not least is not just around reducing cost per unit, it is also bringing revenues up because we want to replicate innovation across the markets and not just productivity. Now, we're not doing it afresh. So if you're worried about something that may sort of rupture the operation, please remember that we already have global platforms highly successfully dispersed across our enterprise today in asset management, in the corporate lines, Allianz Partners, but also in Allianz Investment Management, our really strong platform that is delivering us between 40 and 50 basis points every year in risk-adjusted outperformance. So we're going to do that, and again, we'll talk about that today in more detail. The idea is, and page 20 is just an illustration, we have to therefore bring the scale to something that you eventually need to see in hard code numbers. We have to bring growth up beyond where it is, organically, not through M&A. We have to move the profitability significantly, and we can do a lot more. And this is where it starts, to bring the customer satisfaction beyond what people believe is possible on the industry average. Now, let me give you one example that gives you an illustration of the power of what we are talking about today. This is an example from our Spanish operation that in Allianz sets in many ways the benchmark for efficiency, and they've worked on it for 20 years. By the way, also outgrowing the Spanish markets on a consistent basis organically. Now, we did an analysis of how can we move even further on productivity over the last 18 months. And then we said, is there any potential to work on the legacy? And the answer was no, because only 3% of the revenues, that's nothing, are in so-called legacy products. 3% of the portfolio is nothing. Most of other business, we have 40, 50, 60% in legacy. Then we took a deep look in the IT cost that is dedicated. And I have to tell you, our cost allocation mechanisms have some room for improvement. And you start to look and you find almost 20% of the total IT budget was dedicated to just 3% of the revenues. And let's assume these 3% are actually profitable from a loss ratio percentage. If you allocate costs properly, it's not making money. So the key message is that even in the best businesses that we run, the upside potential from removing legacy is massive. And therefore, a lot of what we're going to do is in our hands, is cleaning up those legacies. And that is easier said than done. Oh, sorry, let me go back a little bit. The other thing, and that is very important, is we believe, and having looked at a lot of the insurtechs and the startups, that we actually have most of what we need in-house. And as you know, we do invest in the innovators. And what we're going to do is to create a direct platform for Europe. Now, this is not meant to compete with our other distribution channels for the same client base. Factually, cannibalization between our direct businesses and our traditional agency platforms is zero. Let me repeat that. Cannibalization is zero, but we've been missing a massive opportunity across products and moving to the Allianz brand, because that's what our consumers are expecting. They're saying you're camouflaging the fact that you are not giving me what we want. First observation. Second, why do we do it the way we do it? We want to create, for the first time, a legacy-free offer, direct offer to consumers, that is consistent across markets, very consistent with the story that I just tell you, proving the scalability. But there's a second component. We are going to create an operating platform that is designed to cost, that is also going to operate on a legacy-free basis, to create an internal benchmarks for our German, our Italian, our Dutch colleagues to see where we have to go with our operating cost in the legacy businesses over time. It's much more convincing because you can show the how, not just the what, if you have a platform inside. That is the objective of what we're going to do with EDP. So now I move to capital management and give you a few things, because you say you're going to hold me, not just Giulio, accountable for what we do. I think we can be very proud of what we've done the last 3 years. We honored the commitment that Michael Diekmann and Dieter Wemmer gave many years back, but we needed to work very hard to actually honor that commitment, making sure the life balance sheet was improved, the capital was upstreamed, and we actually did execute the share buys that we did back. So what are we going to do going forward? We will remain with the same discipline that we've had the last few years. So there is no itching, no I have to do it. And the discipline is very, very simple. We have the same hurdles we have for share buybacks or capital management overall that we have for internal growth and external growth. There is no difference. There is no difference. And if we buy something, we'll talk about it, we apply the same mechanisms that we apply to managing capital in many other ways. And we're going to get even stricter because we have internal growth also on the page. And I put it on the page for very good reason. Because we have still businesses that where we put capital in that does not have the right returns. We started in life, remember, with the ROE targets for the life businesses, and we're going to apply it across the portfolio. Where's the value growth is where we need to go. So we have the same principles. In addition, on the M&A side, there are two criteria that are very important. First, and we really mean it, we need to be able to extract value from what we buy that is consistent with what we have to pay, and the quality of the franchise needs to be as such that it enhances the performance of Allianz. It just does not just enhance the size. And that is very, very important for you to know. And the record of what we have done over the last few years just speaks to it. You can go through the page in terms of what we bought, and you know, everybody says we don't sell. It's just not true. We sold the last banking assets, Oldenburgische Landesbank. We have a small license left in Bulgaria. We have taken out the back book in Taiwan. We have sold the Korean business. We sold the AGF UK business. And so we are constantly pruning the portfolio. And we're working on the life back books. But what we're not going to do is to risk our reputation by separating from clients that we expect to continuously be our client. That is also very important. And I'd like to mention it at this point. We really care for our reputation very much. Now, by the way, the Korean number is obviously understated given its economic effect. That has allowed us to build the solvency and massively increase the capital returns in order to move to a return on equity number where we are today, and that we're very proud of. And to be honest, I am puzzled, given that we are north of 13% ROE without any accounting tricks, that we are trading where we are trading, because we have many peers, many peers that have massively lower returns and promises, and we don't believe in promises unless you deliver them. Now, let me talk a little bit about the targets and what we're giving ourselves as a target. Now, before I go to this page, there are targets that are not on the page, but they're equally important. And I'd like to mention that. We want to be respected by our peers, our communities, and the societies we live in. I am really proud, for example, that we won the Dow Jones Sustainability Award as the #1 in our industry this year. In the second year, we may not have it always, but that is what we want to be. We're trying to be a company that people are trusting and are proud of, and not just one that produces financial returns. And that's very important. So for the next few years, we're going to spend a lot of time on reputational risk because we do not want to end up where other people are ending up. That being said, and that's important because it will require some decisions to exit certain businesses or do stuff that is maybe less attractive in terms of returns short term, but very attractive in the long run. So you need to trust that Allianz makes decisions for many years to come, not just for the next 4 quarters. Now let me go through the numbers. The most important message today, again, that I'd like to repeat is we don't need help from M&A and others to grow earnings. We don't need. We don't even need share buybacks to grow the earnings because we are giving ourselves a 4% organic growth target year per year over the next 3 years. And we haven't had that in a long time. Now, why we're saying 5+? Because you can assume that we're going to generate significant amounts of capital on top of the organic growth. And as we have very strict return on equity targets, we will not let the capital sit idle. So whatever we don't need, we're going to give back to shareholders or put it into productive investment. That is the commitment we've made 3 years ago. That is the commitment that we renew. But in this environment, we don't want to rely only on capital management. We want to rely on our own earnings power. Profitability, we call it 13% plus. Now, plus, Giulio will say, plus doesn't mean 13.1. And he's going to talk a little bit about what that means. But we also want to be very clear. We are going to move in an environment where volatility is going to be very strong. And that is why we are making sure that we don't overpromise on something that is there. But having the returns that we have today and moving north of that, I think is a very strong commitment from the team. We are removing the 220 headline. We want to make sure that it's north of 180. Giulio will talk about why this is a very important message for you. And last but not least, we've said this is not just about performing for shareholders. It's performing against expectations of our clients, most importantly, because financial performance is the outflow of delighting clients. So we're going to move north of 75 and having loyal leadership ambitions that are stronger than we have them today, and making sure that our employees are mobilized to deliver on the transition. So no excuses for transformation in terms of mobilizing our people. This is the target. Now, if we execute that, we would like to see the following happening. We started in the past with a discount because of the issues we had in PIMCO and the life business. And that was clear, and we had been working, including the last few years before 2015, to make that a much more resilient balance sheet. And I think we've achieved that beyond our expectations. The last 3 years, we committed to disciplining ourselves on capital management, which we haven't been before, and making sure that profitability in all segments goes back to where you expect it to be and beyond. We're closing in on best practice in many segments, and we are very proud of that. We're starting to deliver on organic growth. But what we really need to get to a premium valuation, we believe, is to outperform on productivity, on scalability by being a more simple company, in particular with regards of what we do with our clients and our people, and hopefully also in internal organization. So these are my messages for today, and that reinforces the equity story that we have shown to you 3 years ago. When you invest in Allianz, you sleep well, because you have the downside protection you need from one of the world's best risk managers. We are well diversified, we have an outstanding capital position, and the investment portfolio is getting better by the day. We have a very attractive dividend policy. We don't believe we constantly need to promise people more share of payouts, because we know, and you know, that capital management is not a side constraint. It's at the core of what we do. We have a dividend ratchet, and we are going to bring the money back to you if we can't invest it. You need to trust us that we do the right thing with your capital. And there is enormous upside. Almost all our competitors have given up on global scale. Every single equity story you read is, we give the power back to the markets, we are going to sell portfolio, we're going to focus on 3 markets in Southeast Asia, on 4 here. Think through what this means. We have a different ambition. We have an ambition to say we can really grow earnings better than anybody else because we're going to get to scale. We're going to outperform through continuous productivity gains, and we're going to rebalance the capital to where the growth is. That is our promise. And therefore, we can believe we can organically grow much more than we can do in the past, plus the capital management efficiencies on top of that. We thank you for your support, and we hope that what we are going to do will delight you as it has the last 3 years. Thank you very much for listening, and I hand over to my colleagues.